All right, John Brady is Senior Vice President at MMF Global. He joins us from the CME Group in Chicago. And with us from New York, John O'Donohue, Head of Equity Strategy at Cowen Company. Are you there, John O'Donohue? You are there. Thanks for joining us. Let's talk about what you hear from the Fed today. I mean, some people have been saying there's nothing in the statement to justify the moves that we saw in bonds, but you did see kind of a spike there in yields. What do you make of that?
Well, I think what's going on is there's an asset allocation trade taking place, specifically amongst retail investors, where bond funds are being sold. It's lending itself to volatility, specifically on the back end of the curve. Traders would refer to it as perhaps convexity-related hedging, paying in the swap market. And you're seeing flows back into the equity markets, which is why we've had this slow grinding trade over the course of the last 10 to 12 sessions. So I think retail is actually allocating capital out of bond funds and into stock funds.
Hey, John O'Donohue, what do you think about the S&P here? Looks like we're trying to get to the pre-Lehman levels, 1251.7. We can't push above it, even though when the Fed comes out and assures us it's going to continue with quantitative easing. Why?
Well, I think the market's got a little fatigue at the moment, Matt. I would suspect by year end you may see that magic number, and it can get pushed up there on very light volume as participation tends to wane in the last week or two. But I think we may get there. I think you'll have some bumps along the road here for the next couple of weeks, though.
You know, speaking of bumps, I'm looking at these headlines coming out from the GE meeting today. Jeff Immelt making some comments, and he says he's counting on a European market that's not strong next year. And, you know, Europe is one of those funny things. It's sometimes in the headlines, it's not, but nothing's really significantly changed. John Brady, I mean, is that kind of the big if factor, if you will, as we head into the new year?
I would much rather describe it, Carol, as storms on the horizon, storm clouds on the horizon. You know, there has been a Berlusconi vote of confidence today, and Spain will be issuing some paper on Thursday morning, so that bears watching. But really, the refinancing schedule for the European nations, Spain, Italy, Greece, and Ireland, really picks up in the first quarter of next year. So I don't think that trade is probably going to take place today or tomorrow. I think the ECB will be very careful to support the European sovereign bond market through the holidays and into next year. They will be wary, of course, of lighter volume and sharper moves. But really next year, I think investors want to be very concerned about what transpires in the Eurozone. Yes.
All right. Back to our guest, John O'Donohue of Cowen Company, and also John Brady over at the CME Group in Chicago. John O'Donohue, you know, John Brady was talking about the concerns of Europe into the new year. Where are you on this?
I agree. Actually, being a native Irishman, I pay particular attention to this, but I think the issue that you have is you know, the German-France coalition, if you will, having to bail out all the peripheral countries around the edges, which is getting either to be quite tiresome for the taxpayers and could be a problem, as John said, clouds on the horizon. So I do think you have to pay particular attention to that. I would also point out one thing, that the British inflation numbers came out today, and they were quite shocking to the upside. So I think there's some knock-on effects here as we see some countries starting to reflate a little bit, if you will, and I think the same thing may happen in the U.S.
You know, somebody in the Wall Street Journal today commented that the Greek and Irish bailouts took up about 23% of the entire bailout fund, even though those two countries together make up about 3.4% of all Eurozone GDP. Meanwhile, Spain and Italy make up about 23% of European GDP, and the bailout fund wouldn't be able to bail them out. They don't have the money. They can't afford it. It's too much of a reach. Is that really the big concern, John O'Donohue?
It is. I think it is a big concern. I really do. And I know Trichet was on this morning talking about the fact that they probably had to expand the size of the bailout to be able to take, to be able to sort of mitigate some of the risks that they see on the horizon. So I do think Europe could be a problem in the first quarter.
John Brady, it's kind of a risk-on, risk-off thing as regards to how much we pay attention to this. If it's risk-on, it's no big deal. If it's risk-off, and especially if it's a slow news day, it's all about the Eurozone problems. How does the bond market take this? Because you must be watching it on a daily basis. You don't have the option of risk-on, risk-off, whether or not you want to ignore it.
Well, Matt, we in the bond market really sort of pay attention to the European problem will be in the FX forward space and what transpires with exchange-traded futures like Eurodollar options and futures here at the CME Group. So those tend to be where we would suggest there's fire, or there's smoke rather, and then there's fire in the European community. So we watch some of the FX forwards and the demand by European banks to perhaps fund their assets and liabilities in dollars and what they're willing to pay for that. So rather than getting too technical, I would like to also introduce the idea that perhaps China and inflation and monetary policy in China will likewise affect trade early in 2011 and perhaps introduce the scepter of higher volatility in asset markets. Inflation in China continues to creep a little bit higher. Chinese officials have raised the inflation target for 2011, and if they continue to fight inflationary pressures with targeted monetary and regulatory policy, this whole idea of strains in the dollar-yuan currency relationship may really come under pressure in 2011, once again increasing global market volatility.
With all this in mind, and it's kind of interesting because I'm hearing more and more folks bring up the issue of inflation globally and even here domestically. But let me take a look at the bond yields, because we did see traders push yields higher today. That even as Fed Chairman Ben Bernanke reiterated his commitment to keep rates low. Adam, let's bring you back. Let's talk about what we're seeing here in terms of yields.
Well, Carol, it's really almost Ben Bernanke against the world. And by world, let me tell you what we're talking about specifically. Here's the issues that bond traders have to wrestle and why they're pushing rates higher. On the one hand, the argument for higher yields. On the other, the argument for lower yields. Okay. Inflation. All right. We saw PPI this morning. That's coming in higher. Will that translate into CPI? Consumer price inflation. That's one of the issues. Seems like it's starting to build momentum growth. Guys like PIMCO upping their GDP forecast. We're seeing that. Again, higher yields. Commodity boom. We talk about this every day ad nauseum. Tax reform, deficit spending, all these reasons to argue for higher yields. On the other hand, you have fear, EU debt, unemployment, QE2. But the funny thing about this, unemployment, look, that's why we have tax reform, give people more money. QE2, that's why we have deficit spending. In other words, the arguments for higher yield tend to outweigh the arguments for the lower yield. And let me just show you guys this. And John's, I should say the two Johns, let me throw something out to you. The relationship between the 10-year yield and the SPX. Look at this. They tend to go hand in hand. In other words, higher rates, not a bad thing for stocks, because if rates are going higher, there's growth. You want to own stocks. The two Johns. Do you guys buy into that relationship?
John O'Donohue, you take that first.
I most certainly do. I think the fact that we're seeing a reflation in assets, and I think if the velocity of money tends to pick up here, I think what you will see is the market probably tend to move higher. I mean, I come from being quite old. I come from a school of thought that full employment back in the old days was around 94%. So you had 6% built-in unemployment, and along with that, the risk-free rate of return that really was competitive to stocks in those days was a 6% return. So I see yields could move considerably higher here and not really affect the stock market at all. In fact, I think it would be a healthy thing for that to happen.
John Brady, what do you think? And also, do you think that the Fed at some point in 2011 raises its own benchmark rates higher?
No, I'm politely on the other side of that trade. I think we are seeing a slight readjustment in the bond market to perhaps higher growth in 2011 and perhaps slightly higher inflation. But I still think it's going to be a slow, long recovery in the employment markets. I still think we have a bit of a debt overhang within the economy. I believe that CPI and PPI will continue, at least on the core level, to trend a little bit lower. And I really think the trade over the course of the last 6 to 8 weeks has been more about a positioning trade. Banks and dealers and other financial institutions have been keen to get assets off their balance sheets, perhaps whittle down their balance sheets. So it's been a little bit of a positioning trade. I think some traders have been caught off sides, by being long treasuries at rather paltry yield. So I think this is a rotation trade, but I think the challenge for 2011 is going to be the capacity overhang and the debt overhang that still plagues our economy. And I think employment is going to grow, but grow awfully and painfully slow.